Are your everyday digital payments about to pull a surprise on your taxes? You might be swiping, tapping, and sending money easily, but a twist could change your relationship with your favorite payment apps. Welcome to the turning point of digital transactions. Hello and welcome back to Money Craft Masters, where we turn financial complexity into your next smart move. Today, we're delving into something buzzing in millions of Americans' pockets. It's about the tiny, often overlooked transactions we make daily. We're talking Venmo for your morning coffee, Cash App for splitting dinner bills, and PayPal for that last-minute gift. These platforms have become our financial companions, seamlessly integrated into our lives. But as 2023 rolls in, a new player is entering the game, and it's not just another app, it's the IRS. How does this affect you? And why should you pay attention even if you're just sending a few dollars to a friend? Stay tuned as we unravel the mystery of the new IRS $600 tax rule, a change that might just have you rethinking your next click, swipe, or tap. Are you ready to dive into the world where technology meets taxation? All right, you're now wondering, how did we get here? And why is this change so significant? Let's step back and explore the evolution of digital transactions and tax rules. This journey is not just about numbers and policies. It's about understanding the financial landscape that shapes our daily lives. The digital transaction evolution. Think back to a decade ago. Digital transactions were a convenience, a growing trend. Today, they are the norm. Apps like Venmo, Cash App, and PayPal have revolutionized how we handle money, making it faster, easier, and more convenient than ever. These platforms are no longer just for tech-savvy users. They're for everyone, from freelancers to small business owners, or from college students to retirees. The simplicity of sending money with just a few taps has made these apps indispensable. But with great convenience comes great attention, especially from regulatory bodies like the tax rules. In the past, the IRS tax rules for digital transactions were, let's say, more lenient. The threshold for reporting was set much higher. Businesses using these platforms had to cross a significant transaction number and a substantial total amount before triggering tax reporting requirements. This meant that many small transactions flew under the radar like most of us every day. These rules, however, were designed for a different era, one where digital transactions were not as ubiquitous as they are today. Introduce $600 rule, and then comes the major shift in 2023. A rule that lowers the reporting threshold dramatically from a world where only significant transactions caught the IRS's eye to one where almost every transaction could be under scrutiny. But what led to this drastic change? Was it just about collecting more taxes, or was there something more? The rationale behind this shift is as intriguing as the rule itself. It reflects changes in our economic structure and a response to the evolving nature of how we use money in the digital age. Setting up next. As we dive deeper into this topic, remember that this isn't just a story about taxes. It's a narrative about how our financial behaviors are changing and how the systems around us are adapting. In the next section, we'll break down the specifics of this new rule, how it might affect you, and perhaps most importantly, what you can do about it. Is this new rule a hurdle, an inconvenience, or a formality? Stay tuned as we uncover the layers of this significant financial update. Now that we've set the stage and understand the seismic shift in the landscape of digital transactions, it's time to zero in on the core of our discussion. What exactly is this new IRS rule? How does it redefine the line between personal and business transactions? Let's peel back the layers of this new regulation to see what's at the heart of it, how it could directly impact your wallet. Full new rule explained. First things first, let's define the rule. Beginning in 2023, the IRS requires all digital payment platforms to report commercial transactions totaling over $600 per year to the IRS. Yes, you heard it right, just $600. This starkly contrasts the previous threshold, which was set at $20, 0 and 200 transactions. This dramatic change means that more people than ever before will find their digital transactions being reported to the IRS, understanding implications. Now, before you start panicking about every cup of coffee or movie ticket you've Venmo'd, let's break this down. The key word here is commercial transactions. This means the rule targets payments for goods and services Not your transactions like reimbursing a friend for dinner. But here's where it gets tricky. How do these platforms differentiate between a personal and a business transaction? That's the million-dollar question we'll explore in more detail. The gray area. One of the most intriguing and, frankly, confusing aspects of this rule is the gray area between personal and business transactions. For instance, if you're a freelance graphic designer receiving payments through PayPal, it's clear that these are business transactions. But what if you sell an old piece of furniture on Facebook Marketplace and get paid via Venmo? Does this count as a commercial transaction? This ambiguity is something that many users of these platforms will have to navigate carefully. Why change? But why such a drastic change? The IRS isn't just trying to make life harder for the average Joe or Jane. The goal is to narrow the tax gap, the difference between what the IRS is owed and what they receive. With the surge in digital transactions, especially in the gig economy, this new rule aims to bring more transparency and compliance. It's an adjustment to the modern economy, where microtransactions are not just prevalent but significant in aggregate. The big picture. As we explore further, remember, this rule isn't just about taxes. It reflects our evolving digital economy, how we interact with money changes, and the laws adapt in response. In the next part, we'll dive into how this rule affects different types of users and what you can do to prepare for it. The implications are vast, and understanding them is crucial for everyone navigating this new digital financial landscape. Armed with an understanding of what the new IRS rule entails, it's time to turn our lens to the most crucial part of this discussion. How does this rule impact you, the user? Whether you're a regular on Venmo, a Cash App enthusiast, or a PayPal pro, this change isn't just a line in the tax code. It's a shift that could impact your digital wallet. Let's dive into the real-world effects of this rule on everyday users like you and me. Effect on Venmo, Cash App, PayPal users. Let's start with the casual users, those who use these apps to split bills with friends or pay for a personal service like a haircut. For most of you, there's a sigh of relief. Personal transactions are not the target of this new rule, but there's a catch. Ensuring that your personal transactions are clearly marked or separated is essential. Why? Because if the IRS gets a report of your account receiving over $600, they won't know if it's for selling a used guitar or paying your share of the rent. This ambiguity can lead to unnecessary headaches come tax time. Next, we've got the gig workers and small business owners, the backbone of the digital economy. The new rule is a game changer if you're in this group. Receiving payments for your services or products through these apps now requires more attention. Every transaction adds to your total, and crossing the $600 threshold is easier than you think. It's not just about paying taxes. It's about being aware and prepared. Record keeping becomes your best friend, ensuring you can accurately report your income and expenses. A few eBay or marketplace sales may seem minor, but the IRS may deem you a small business at $600. Rethink your online sales and transaction categorization. Digital financial responsibility is needed. This rule tracks your economic footprint with all digital transactions, not just significant ones. Despite their convenience, digital payments have responsibilities. Be aware of changing digital transactions. Whether you're a casual user, gig worker, or small company owner, here are some practical tactics to get you ready and ahead of the game. Get ready for change. Records are the first and most crucial step. A transaction monitoring system may make you an overnight accounting expert. You may label and classify transactions using applications. Consider financial tracking applications, especially for corporate transactions. Good records simplify taxes and reveal financial habits. Keep personal and work matters separate. Separate accounts for personal and corporate use or rigorous app transaction classification can help the IRS separate personal and business transactions. Blurring these lines can lead to complications and audits, which everyone wants to avoid. Talk to experts. The tax system is complex and dynamic. These patterns must be followed. Follow reliable financial news, newsletters, and forums. Most crucial, contact specialists. Tax advisors specialize. They may give customized tax techniques to enhance your situation and ensure compliance. Prep for tax season. Finally, the new law emphasizes tax season preparation. Start early, acquire paperwork, and know your taxes. Be ready to declare income exceeding $600. Proactive tax planning prevents last-minute mistakes and unexpected tax. As we conclude this section, remember that change is difficult, but offers learning and progress. This new tax law requires preparation and advances your financial path. In the following part, we'll address common inquiries and dispel myths to prepare and enlighten you. We have questions after understanding the what, why, and how of this significant IRS rule change. You have company. As with policy shift naysayers, many onlookers are concerned. We'll clarify the air by answering common queries. Digital transactions and taxes generate real-world insomnia. FAQs, all payments, even small. And must small payments be reported? Short answer, no. The $600 limit applies to annual transactions, not individual payments. IRS doesn't like dinner bill splitting. You must disclose all purchases, including little ones, over $600. What if I utilize these applications for personal and commercial transactions? Create additional Venmo, Cash App, or PayPal accounts, or label your transactions to differentiate personal from business transactions. IRS misconceptions are best avoided with clarity. Will this regulation affect my taxes? Another good question. This rule affects reporting, not taxes. How does IRS transaction visibility affect you? Including money from these sites in your tax calculations is more likely to expose it. You must pay the right amount of tax, and this regulation boosts our surveillance. Why are business transactions different from personal ones? Separating personal and commercial ties is difficult. Mark each transaction and keep invoices or notes to make tax season payment, identification, and reporting more manageable. How should I handle ambiguous transactions? Ask a tax specialist if you need clarification on whether a transaction is personal or business or how to record it. Situations are advised on. Remember, prudence and counsel can prevent problems. This FAQ should answer some of your issues. Tax rules are complicated, but knowledge is power. Watch our video conclusion and key takeaways. This new IRS regulation, answering your pressing questions and offering practical strategies, is almost over. We thank everyone who helped simplify this complicated issue and advise you to utilize this information properly before we end. Our third component, credits and disclaimers, is essential for prudent financial advising. This video discusses the new IRS $600 tax rule and its ramifications, but it's not tax, legal, or financial advice. We propose tailored guidance from trained specialists because every scenario is different. Finance and taxation change often. Therefore, contacting experts is essential. After reviewing the new IRS $600 tax rule for 2023, we may discuss how it may benefit you financially. Though complex, tax laws and digital transactions help us make better financial decisions. Our last ideas and views will reassure and clarify. The new IRS law that mandates Venmo, Cash App, and PayPal to reveal business transactions above $600 per year changed tax laws and affected casual users, gig workers, and small company owners. Adapting to this rule requires careful record keeping, differentiating personal from commercial interactions, and remaining updated. As said, digital transactions are changing, and so should our management. Prepare for this transition with a stronger financial organization or professional help. This conversation goes beyond learning a new tax regulation. The goal is to raise digital financial awareness. Every transaction affects our financial story, no matter how tiny. We can connect our digital financial footprint with our goals and obligations by being aware and proactive. Money craft masters should absorb and discuss this. Tell your tale and educate others. Understanding and addressing these subjects improves money. Financial success requires flexibility, knowledge, and preparation. Money craft masters will enlighten and guide you. We enjoyed your company on this enlightening tour. Every money instruction helps you master it. Continue learning and exploring. Let's progress. For now, Money Craft Masters advises caution.